What is up, guys? Logan here again. Thank you guys for all the support as always. The Discord is popping, closing in on 200 members if we're not there already. And in this video, I want to talk about the Greeks with options trading, and this is the Delta, Gamma, Vega, Theta. That stuff's super important when it comes to the volatility of a stock and how you could see a price or premium move. It's pretty much the sensitivity. Like the Delta measures the sensitivity of an options premium to a change in the price of the underlying asset, while the Theta tells you how the price will change as time passes. The Theta is super important. We'll hop into all this. Thank you guys for using the links. Check out the Great Lakes Wellness link as always. We got the Robinhood link. Always pop in that Discord if you're not already. We do live trades Monday through Friday. So let's get right into this one because I am pumped. I know you guys are pumped. Let's learn about some Greeks with options. So when it comes to finding values for the Greeks, I love using Investopedia. First, you should understand the numbers given for each of the Greeks are strictly theoretical. That means the values are projected based on mathematical models. Most of the information you need to trade options, like the bid, ask, last prices, volume, and open interest, is factual data received from the various options exchanges and distributed by the brokerage firm. The Greeks need to be calculated, and their accuracy is only as good as the model used to compute them. That's important. To get them, you will need access to a solution that calculates them for you. Most of the retail brokerages also provide this information. Naturally, you could learn the math, calculate the Greeks by hand in each option, but given the large number, it would just be unrealistic because of the time, which it states right here. But it also shows you, like, so you can understand, the left section shows the call options while the right section shows the puts. The out of money options are those with strike prices above 60 for the calls and strike prices below 60 for the puts. So we can scroll in over here, strike prices. So you have your Delta, your Gamma, your Vega, your Theta. And it says right here, if we go down, the figures shown above are normalized for dollars. To normalize the Greeks for dollars, you simply multiply them by the contract multiplier of the option, which is 100 shares. Delta measures the sensitivity of an option's theoretical value to a change in the price of the underlying asset. It is normally represented as a number between -1 and 1 and indicates how much the value of an option should change when the price of the underlying stock rises by $1. So you can see your Delta, and like we'll go down here, the normalized deltas above show the actual dollar amount you gain or lose. For example, if you own the December 60 put with a delta of -45, you should lose $45 if that strike goes up by $1. The delta isn't super important. I always look at that before I make a trade so I can see how much the stock has to move for me to hit my 10, 20, 30% profit zone before I yank profits out. This is how I make all my moves. When I put $500 into Facebook and want a 10% return within an hour, I look at the delta to see how much the stock would have to move for me to move $50, cash out, and go on about my day because, you know, everyone has monthly goals. We have weekly goals of how much money we want to make trading. And if you can stay strict to learning the rules and putting in your own place with the Delta, this is where you really thrive. Delta and the Theta are like the two most important things, especially if you have contracts that expire soon. But Delta is super important and you guys should continue to every trade. Do not overlook the Delta because that's your, I call it home base, which is a little weird term, I guess you could say. That is basically the main factor you pick the contract that you pick is because let's say you think something's gonna move $3 and that will cause your actual price to move, let's say $30. You can make 90 bucks if a stock goes from like $110 to 113 or something like that, whatever the delta is for that trade. Delta is such an important factor. Options traders are also interested in how the delta may change the stock price. Gamma measures the rate of change in the delta for each 1 point increase in the underlying asset. It is a valuable tool in helping you forecast changes in the delta of an option or an overall position. Gamma will be larger at the money options and goes progressively lower for both in and out of the money. And that's for a lot of you people who trade, which is mainly what I do too, so I'm not singling anybody out. I don't buy in the money calls. I buy one step out or even two. If I ever do 3 or 4, it's because I'm trading a stock with a very expensive premium, and expensive for me is over $1,000. I will go 3 to 4 spaces out, but if we're talking most of my trades are 1 space out of the money, because it's a little cheaper and there's more room to, you know, grow. The premium has a higher chance of moving a little bit more. And I always just sell premiums. I never exercise my calls. And if you're only one space out of the money and it decides to drop, it's not that drastic as if you are 3 to 4 spaces out of the money. And I talked a little bit about this in my how to trade options video, and that's another place you guys can learn after watching this if you haven't seen that one. Theta is the measure of the time decay of an option, the dollar amount an option will lose each day due to the passage of time. For at-the-money options, theta increases as you approach the expiration date. For in and out-of-the-money options, theta decreases. Theta is one of the most important concepts when you learn to option trade. The further out in time you go, the smaller time decay. If you want to own the option, it's advantageous to purchase long-term contracts. If you want a strategy that profits from time decay, you will want the short-term value options, so the loss in value due to time happens quickly. And this is where people hop into things like leaps. And leaps are where you can jump into maybe trading a stock like Shopify to where, okay, a couple years ago you could have got it for 200 bucks and maybe you had like a $300 call, and now that's in the thousands range, you're looking at a huge return instead of just what you would have, you know, like a 500% return just holding the stock from 200 to 1,000. But if you would have option called it or anything like that for long term, you'll still pay less in taxes than a short term guys. But the reason that we all trade short term too is, you know, those premiums and the theta quick. You know, let's say it shoots up $5 and it expires that week, you're gonna be really, really profitable. But if it goes the other way, you could be getting hurt for like 40 to 50% of your investment. So that's something you gotta be careful of too. And that's why I like leaps. I think it's cool to buy stuff long out because if you're patient, why not pay less in taxes? So the final Greek we'll look at is Vega. Many people confuse Vega and volatility. Volatility measures fluctuations. So a change in volatility will affect both calls and puts. An increase in volatility will increase the price of all the options on the asset. And a decrease in volatility causes all the options to decrease in value. Each individual option has its own Vega and will reach the volatility charges a bit differently. The impact of volatility changes is greater for at-the-money options than it is for in or out of the money options. While Vega impacts the calls and puts similarly, it does seem to affect calls more than puts, perhaps because of the anticipation of market growth and just in general, you know, America's super bullish. Betting against them is not the move, so come join the bulls. The effect is more pronounced for longer term options like leaps, which I explained earlier. So that's just a quick rundown of the Greeks and, you know, how they affect your trading. And we can get super in depth with this and go through, you know, every step, and that could be a great video for me in the future where I actually take a stock and trade it live to show you guys how the Greeks move in real time, especially if you've never traded before, you're completely new to it. Definitely check out Options Trading Calculator to see like how prices would move over time depending on how the stock moves. So that could be another great place for you to learn about theta and how the delta works on stocks. And the theta can really eat you up if you're in the weekly pull. But I just hope that gives you a good understanding, because looking at the Greeks is the best way to manage the amount of risk that you're taking. Whether you're buying out of the money calls or in the money or at the money calls or puts, the theta and delta will really help you position yourself into a better position. And then also like the Vega that we talked about too. Just risk management is what we're all about here, because we want our money working for us and our money not working against us. It should be the other way around. It should always be working for us. You know, money's a tool, so why not just have it make more money for you? But that's gonna be it for this video. I hope you guys gained a massive amount of value. Don't forget to leave a like. Don't forget to subscribe. I'm gonna keep up with these options videos, and I'm just having a blast with it. Some of the most fun I've ever had. You know, just making money trading, and options really give you the ability to do that quicker. Just stay safe, and don't forget to join the Discord. It means a lot, and I will see all you guys in the next one.